First, I want to say I hope everyone stayed safe and warm during that historic cold snap we had this weekend. Florida isn't exactly built for freezing weather, so I hope you're thawing out nicely. I know I'm still working on it myself. All right, today let's talk about capital gains tax. So first, what even is capital gains tax? Well, capital gains is simply a tax on profit. If you sell something for more than you paid for it, the profit is considered a gain. The IRS treats that gain like income. So here's where people get frustrated, understandably so. You paid taxes when you earned the money to buy the house in the first place. You pay property taxes every single year you own the house. So why is there another tax? Well, the IRS looks at appreciation like brand new money that was created over time. So technically, they consider it new income. But here's the good news, and most homeowners don't even realize this part. If the home was your primary residence, there is a huge tax break. You can exclude up to $250,000 in profit if you're single, or $500,000 if you're married filing jointly, as long as you've owned the home and lived there for at least 2 of the last 5 years. So many homeowners who've lived in their house for years actually pay zero capital gains tax. And there's other ways your taxable gain can shrink too. Things like major improvements, like a new roof, new kitchen, new AC system, plus closing costs and selling expenses. All of those can reduce the profit on paper. So now let's talk about something especially important, because this is where I help a lot of families, and this is probate and inherited homes. When a loved one passes away and you inherit a home, most people worry they're going to owe a massive tax bill because mom or dad bought the house decades ago for a much lower price. But here's where the rules are actually very forgiving. Inherited property typically receives what is called a step up in basis. What that means is the home's value resets to what it's worth at the time of death, not what it was purchased for years ago. So, for example, if your parents bought the home for $90,000 and today it's worth $400,000, you don't use that $90,000 number anymore. Your new starting point becomes $400,000. So, if you sell it for $405,000, your gain is only $5,000, which often means little to no capital gains tax at all. And if you're helping a spouse or parent who is mentally incompetent and you're acting through power of attorney, we typically look at it more like a primary residence sale and apply those same homeowner exclusions when possible. So it really comes down to proper timing, documentation, and having the right professionals guide you. So here is the big takeaway. Capital gains tax sounds scary, but for many homeowners and many probate families, it's often reduced or completely avoided with the right planning. If you're thinking about selling or you're navigating a probate or inherited property and just have questions, let's talk before you make any big decisions. I'm probate certified, I work closely with attorneys and CPAs, and my job is to help families understand their options and protect their equity. You can call me, text me, or message me anytime, even if you just need some clarity. Because the last thing you should be worrying about during a life transition is surprise taxes.